The second illustration, MNP Limited sold
2,75,000
units
units.
of products at rupees 37.50 per unit. Variable cost are rupees 17.5 per unit, and in that manufacturing cost of rupees 14 and selling cost of rupees 3.5 per unit. Fixed costs are incurred uniformly throughout the year and amounting to 35 lakhs, including the depreciation of 15 lakhs. There is no beginning or ending inventories required. Compute break even sales quantity, break even sales level quantity, and cash break even sales quantity. So we have to ignore the depreciation while considering the cash break even, because depreciation is a non cash expenses. Chalo, let's do that. Illustration 2. We have to calculate your break even sales level quantity and break even cash break even sales level quantity. So we'll write the formula for this. Break even sales level quantity is equal to fixed cost divided by contribution per unit. Your fixed cost is given. Fixed cost
35 lakhs
divided by contribution per unit we have to calculate. That is, contribution per unit is equal to sales minus variable cost. Sales is equal to 37.5 minus variable cost is equal to 17.5. So that is equals to 20 rupees per unit. So contribution is 20. So if we divide that, we'll get 1,75,000 units. Now we'll calculate the second one. Cash break even sales quantity. So this will be fixed cost is
20 lakhs because
the fixed cost includes depreciation. So depreciation is a non-cash expenses. So we have to ignore this. So 35 lakhs minus 15 lakhs is the depreciation. That comes to 20 lakhs. 20 lakhs divided by 20, 1 lakh units. So illustration 3 is, you are given the following particulars to calculate: A. Break-even point. B. Sales to earn a profit of rupees 20,000. In that, fixed cost will be 1,50,000. Variable cost rupees 15 per unit. Selling prices rupees 30 per unit. Chalo, let's calculate. Illustration 3. First is, we have to calculate break-even point. Break-even point. So break-even point is equal to fixed cost divided by contribution per unit. Contribution per unit, that is equal to 1,50,000 is the fixed cost it is given, and contribution will be sales minus variable cost. So sales minus variable cost, sales is 30, variable cost is 15, so contribution per unit is equal to 15 per unit, so divided by 15, and that is equal to 10,000 units. The B part is to calculate sales to to earn a profit of 20,000 rupees. So the formula will be fixed cost plus profit, desired profit, desired profit divided by contribution per unit into selling price per unit. So your fixed cost will be 1,50,000 plus the desired profit is rupees 20,000, that's given here. So 20,000 divided by contribution per unit is equal to 15 into selling price is 30 rupees. That is equal to 3,40,000. In a module they have given another method, you can use that also. Or fixed cost plus desired profit divided by PV ratio. Same as the above formula, but instead of this part they have given the PV ratio. So that is equal to fixed cost is equal to 1,70,000. That is 1,50,000 plus 20,000 divided by here we have to find out the PV ratio. So PV ratio will be contribution divided by sales into 100. So contribution is equal to 15 divided by 30 into 100. It is half, so it is 50%. So divided by 50%. Then it would be 3,40,000. Same answer for both the methods. Illustration 4. A company has a PV ratio of 40%. Compute by what percentage must sales be increased to offset 20% reduction in the selling price. Okay.
There is change in the sales quantity by 20% reduction. So therefore, when there is change in the sales price per unit, automatically contribution per unit will also change. So it leads to new PV ratio. So we have to find out new contribution, new PV ratio, and we have to compare the standard one with the new thing. Then we will get the difference between that.
We have said that contribution is 40%. Therefore, if the sales is 100% and the contribution is 40%, so the variable cost, sales minus variable is equal to contribution, yes or no? So the difference is 60%. So the variable cost will be 60% here. Now this is the normal scenario in what they have given. If there is reduction by 20% in sales, only in sales, okay, so then sales will be 100 minus 20%. 100 minus 20% will be 80%, and variable cost will be the same, 60%. So the contribution will be 20%, and the PV ratio will be, this will be the revised PV ratio or new PV ratio, let's say that. So PV ratio will be contribution divided by, PV ratio will be contribution divided by sales into 100. So, and that comes to, this is contribution is 20 divided by sales is 80% into 100. This will be 25%. So the new PV ratio will be 25%. Okay. Here they said that sales is changed but not the contribution. Contribution will be fixed. So we'll find the new sales value. For that we'll use a formula. So revised sale value is equal to desired contribution divided by new PV ratio. Okay, the contribution is fixed, that is 40%, and the PV ratio will be 25%. So the desired sale value will be 1.6. So now we will find out the sales quantity, new revised sales quantity. Revised sales quantity. Revised sales quantity is equal to desired contribution divided by PV ratio, new PV ratio into the selling price, the revised selling price or new selling price. Okay, desired contribution will be 40% and the new PV ratio will be 2.5 into revised sales was 100%. If it is reduced by 20%, so then it will be 80%.
The revised sales quantity is 2. What it indicates is if there is a reduction in the selling price per unit by 20%, the sales quantity must be doubled, okay, twice the normal quantity to meet the normal contribution. Okay.
Illustration 5. PQR Limited has furnished the following data for the 2 years 2013 and 2014. Sales, they have given 8 lakhs for 2013 and for 2014 we have to calculate. They have given profit volume ratio, margin of safety as a sales of percentage of total sales. Then they said that there has been substantial savings in the fixed cost in the year 2014 due to the restructuring process. The company could maintain its sales quantity level of 2013 in 2014 by reducing the selling price. You are required to calculate the following. 1. Sales for the 2014 in value. Second, fixed cost for 2014. Third is break-even sales for 2014 in value. In this question, they haven't provided any information to calculate any values for the year 2014. So using the previous year, we will calculate those.
They have given that sales is 8 lakhs.
PV ratio for the year 2013 is 50%. So the variable cost will be 50%, that is 100 minus 50%. For 2013, the variable cost will be 8 lakhs sales into 50% is the variable cost, that is 4 lakhs. And they said that the quantity of 2013 and 14 hasn't changed. That's why variable cost for 2013-14 will be 4 lakhs. They have given that PV ratio for 2014 is 37.50. If PV ratio is 37.50, then variable cost ratio will be 100 minus 37.50, and that will be 62.5%. Okay, so using this we can find out our sales. If the variable cost is 4 lakhs to the extent of 37.5%, then how much is for 100%? We have to calculate like that. So 100 divided by 62.5%. 62.5. It's not per 62.5. That will be 6,40,000. So sales for 2014 will be 6,40,000. Then we can also find out the third question's answer, that is break-even sales for 2014. Okay, so they have given that marginal safety level is 21.875%. So the break-even sales will be 100 minus 21.875%, that is 78.125%. Okay, so break even sales is equal to 6,40,000. This is the sales for 2014 into 78.125%. That will be equals to 5 lakhs. Okay, then we will find out the answer for question number 2, that is fixed cost for 2014. So there's a formula for that: BP sales into PV ratio. We have got 5 lakhs into PV ratio will be 37.50% for 2014. So here it comes to 1,87,500. That's it.